Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to Ticker Talk with Louis and Tommy. It is January 20th, so we are recording a little bit later. But with the holidays and the new year and everything, it's just the way it is. And we've got some data, we've got some thoughts on the fourth quarter of 2025. 2025 was packed with a lot of stuff. If you looked at the returns, somewhere between 15-18%, which, you know, if you're looking at 2023 and 2024, you might yawn a little bit at, those returns. But, man, it was another great year, and we're going to break down the fourth quarter for you.
Third year in a row of mid-teens or better returns. So that's pretty strong.
Yeah.
Actually, we should just be thankful if we're flat this year and consolidate those gains, let earnings catch up, and we'll see you in 2027.
Yeah.
So there's the easy part. But there's more to it than that.
There's a lot more to it. We ended the year feeling good. Overall, we ended the year on a positive, uptick in terms of the market. We didn't get a crazy Santa Claus rally, but we were positive for the fourth quarter.
That's correct. And part of that is just remember the market's always looking ahead.
Yeah.
So it's always looking ahead. So the market's going, we're going to finish 2025 strong because nobody's going to sell the last month.
Right.
And incur all that tax that you have to pay in April. Whereas if you just wait until 2026, you can defer those payments over a whole year. So, there's a little bit of a seller strike usually in December, unless there's a big headline going on or something. But in general, less sellers, everything kind of hangs out. But also for 2026, there are some things on the horizon, right?
Yeah.
There's all that stimulus is going to come in 2026 from the tax bill that passed in July of last year. So this ought to be the largest amount of refunds we've seen in decades. They're estimating close to $150 billion in tax refunds, which will start to hit the consumer's wallet February to say May.
Yep.
For those that get a refund.
Yep.
And not everybody does.
And a lot of these refunds are, probably going to be unexpected.
Correct.
How big they are, because a lot of times people just pay their taxes and maybe they count on getting $1,000, and these numbers are rough. But say that's going to double,
right? Well,
all of a sudden that's a lot of economic impact.
You can deduct twice as much on your house from the state and local property tax.
Yep.
Went from $10,000 to $20,000. People didn't adjust their withholdings for that.
Nope.
If you're in the service business, no tax on tips on the first $6,000. If you're retired, parts of your Social Security are untaxed. And again, nobody changed their estimates. Nobody changed their withholding. So all of a sudden,
and you didn't even include the standard deduction.
Right, standard deduction
is
increased.
Bigger. The child tax credit was expanded a little bit. So there's so many, and these are all, when we say stimulus, this is not necessarily stimulus in the form which we've come used to hearing it, which is a, direct injection of cash into your bank account.
Right. It's just your money
like
back.
It was in COVID.
Right. No, this is just your money. You've already paid in taxes coming back to you.
And you just didn't owe as much as you've paid in, and so you're gonna get it back, hence refund.
So that's more consumer spending. That's good for markets, earnings. And so we're looking at about a 14% increase in the overall earnings of the S&P 500.
Yeah.
And because the markets always look forward, the end of 2025 was like, oh, that looks really good. Oh, by the way, there's going to be a new Fed chairman in May. And given the president's proclivities to wanting to cut rates, I'm going to guess that's one of the things they are interviewing is like, how do you feel about rates? I feel like they're going to cut them. We should cut them. Well, then you're hired.
Yeah, you're hired.
So the market said, all right, new reserve chair, probably lower rates. And then the one caveat in here is there are midterm elections coming. Mm-hmm. Midterm elections typically in a president's first year is a real question mark. Mm-hmm. Typically, the House of Representatives at least flips parties. Mm-hmm. That creates uncertainty, and everybody kind of freaks out near the election, and maybe they sell off stocks. Maybe the other two factors mitigate that. Maybe the fact that you have divided government, so nothing gets done. Yeah. Believe it or not, the market kind of likes that.
Yeah, sometimes that's pretty good.
Yeah. And the market's finicky, right? It's like, hey, we'd really like that tax bill, but then don't do anything else.
Exactly.
So, but those are the things that happened at the end of 2025. All of that went in the blender. All of that pushed up stocks and tariffs that we talked about on multiple occasions through 2025 really didn't have the just huge negative impact.
The big thought, the big headline since basically January when they were first mentioned and April when they were first imposed was that, hey, if you impose tariffs, then
you'll cut
basically
demand.
The end consumer ends up paying that because the price of goods goes up, hence inflation, which we have finally sort of lassoed and gotten almost all the way under control, is going to take off, and it hasn't happened.
Right. Well, it just has been less than thought. Mm-hmm. The overall tariff rate is around 12 to 15% across the board. Some items are exempt. Some items, they've already been there. We've had it on steel now since 2016, 2017. Yeah. Mm-hmm. So you get used to it. But it is creating capital. Mm-hmm. The U.S. government is pulling in billions of dollars.
They are.
Which is reducing the deficit. Mm-hmm. So that has a positive effect. It doesn't eliminate the deficit, just to be super clear. It's just reducing our outlay. But if we look at, and we'll have a chart that you should see here that just shows the returns, the markets at a glance. Mm-hmm. And I mean, to your point, large cap S&P 500 core up almost 18%, large cap growth up 22%. Large cap value, typically your dividend paying stocks up 13%. But honestly, those were just
Yeah, those are afterthoughts, and you see a little hint at something interesting when you're looking. Large cap growth has been all anybody's talked about since almost 2019, and really maybe even a little bit before that.
So in light of all these tariffs, in light of all this international flow, what happened to international markets, Louis?
International markets ripped, and prognosticators have been waiting. Talking heads have been waiting for international to rip for 2 decades.
07.
So, I mean, it's 2026, so 19 years. This is going to be the year of international. And if it wasn't that, this is going to be the year of small cap. Well, it wasn't the year for small cap, but we saw some late life out of small caps. But holy smokes, it was the year for international. And it was the year for gold, silver, and precious metals and some commodities.
Yeah, so developed markets up 32%, emerging markets up 34%. Now, off of a really small bot.
Yes.
So,
but still, give them their flowers. I mean, it's a heck of a...
In absolute terms, the U.S. market still grew more in dollars.
Yes.
Okay, in aggregate. Mm-hmm. But give them their flowers.
Yeah.
They had it was about time, 34% emerging markets, 32% developed. And then on this chart, we'll circle it for you, but the US dollar down 10%. So, not to get too weird here, that helps silver, gold,
right,
and international, because it's a tailwind to international markets when the US dollar declines.
Yeah.
Some of that's on purpose. Everybody talks about king dollar, strong dollar, strong dollar. I get that, but it is, some of our biggest companies, Apple, right?
Yep.
Microsoft, they sell things outside of the United States.
Lots of things.
Yes. And so it takes, fewer of the local currency to come back into dollars. So it increases their earnings. So let's just say it this way, Louis. It was kind of a love fest.
Yeah.
It was a little bit of a love fest. Everything higher. It was great.
Bonds did their job the whole time as well. So that's, sort of refreshing after we've seen bonds do some interesting things the last couple of years.
Yeah, I mean, bonds were higher almost to the tune, including the coupon, up almost 7%.
Yeah,
that's really strong.
Yeah,
looking at the aggregate index on bonds.
Yeah.
So, just again, overall a great year, but let's just remember volatility happens every year.
Yeah.
Okay, so we put this chart up. We put it in newsletters. We remind people of it all the time. Volatility happens every year. So this year was Liberation Day.
It was I love when everybody talks about it now. Everyone says so-called Liberation Day.
Right. Others call it so-called Liquidation Day.
Yeah, Liquidation Day is another good one. But I mean, man, we are so short. We have such short memories a lot of times when it comes to the market, because and we almost get greedy sometimes, because it's like, man, the fourth quarter, like, if you own large cap stocks, which the majority of people
now, of course,
via their 401k or an investment, the majority of your holdings are probably U.S. large cap stocks. And so you are looking at the fourth quarter and you're like, golly, like, I'm up like 1%. Like, nothing happened. We couldn't get more than that. Surely, iPhones are selling. I got a new iPhone. Like, forgetting the fact that in April, we went almost into bear market territory.
Down
in
19%.
In 1 week.
Right.
I mean, and it was bad. And quite frankly, the only thing that stopped it was the president saying, I'm just kidding.
Well, he put a pause. They put a pause on the tariffs. But here's, and when you look at this chart, it is, 2023 up 26%, 2024 up 25%, 2025 up 18%. But look at the red dots. Each of those years, those were great years. Each of those years, down 10% in 23 at some point, down 8% in 2024 at some point, down 19% in 2025 at some point. You have to be okay with going down. It's part of what makes it investing. Otherwise, you're not investing, which we talked about before.
Well, and on that chart, we like to call those red dots reasons to sell. Like, those aren't just dots on a chart. It sometimes is a little easy to just look at that and be like, oh, well, I mean, I know the market goes down and then it comes back up. No, like, there's reasons to sell at those red dots.
Right.
And they're a lot of times super personal reasons, because you may be down more than that red dot. That's just the S&P. So,
yeah. So, okay. So, Louis, then let's talk about, like, all right, well, what makes you guys so sure? So here on this chart of the economic growth of the country, let's just look at, on the far left here is the GDP, the gross domestic product of the United States of America. This is everything that we sell, manufacture, produce, sell it to you, me, people overseas, whatever. And that's how you measure how big your economy is. In 1990, we're right around that $10 trillion mark.
Yeah.
Fast forward to today, and we're around $26 trillion. Okay.
That's amazing.
So you've more than doubled over that period.
Mm-hmm.
And then you sort of follow this little red projection out here, and we're headed towards a $30 trillion economy. By the way, the economy grew 4%
Mm-hmm.
the last quarter of the year. So if you're just looking at why are these companies going up, it's because our economy is growing. And then you see here what that's comprised of for those of you that want to dive into that. But it's just the net effect is this. It's a really big economy.
Yeah. Well, and to dive into, if you're listening, not watching, I mean, it's important to remember, man, the government spends a lot, or man, the majority of my net worth is made up of my house or my 401k. Like that's my whole net worth is my house and my 401k. But the GDP is carried by the consumption of goods and the consumption of services. 2/3 of GDP and almost half of GDP is just services alone.
Right.
And so, I mean, that is, people going out, making something and selling it or creating an experience. And that's America. That's the American economy.
It is.
In a nutshell. So it's just cool to see it in a chart form.
And then and so then how does that relate to the stock market and what have you? Well, it's profits, right? So you sell things and then you have profits, right? So, it's a real simple deal for business. Revenue minus expenses equals profit.
Yeah.
So something has to go to the bottom line. And if we look at corporate profitability in the next 12 months, we're looking at earnings, as a percentage of sales pushing towards 15%.
Right.
So you sell $1, you got 85 cents of expenses. I got to pay employees. I got to pay rent. I got to pay transportation. I got to ship stuff, whatever. Looking at 15 cents of every dollar that I sell going to the bottom line.
And so if you're looking at, man, we're coming off of 3 years of, just crazy good market returns.
Yeah, this is ahead of itself.
And multiple expansion and, everything's expensive. Is now a good time to get into the market? I don't know. Everything looks expensive. But the 20-year average on, profitability is somewhere around 11%.
Right.
And so if we're approaching 15%, it would stand to reason that the market, would be more expensive because the market's making more money.
And what are we seeing? We're seeing productivity gains. Those productivity gains are coming from innovation, right? AI is a real thing. That chart of the corporate profitability, you'll notice it takes a big leap up.
Yeah.
Around 2021, 2022. What happened then? The introduction of ChatGPT, right? And all the things that has spawned.
Absolutely.
And then, coupled with that, those corporate profits as a percentage of GDP pushing, not 15% yet, but pushing towards that. Louis, $30 trillion of GDP with a profitability of 15%. Is insane.
It's insane. And so we don't know what's going to happen, but it would stand to reason that the market looks expensive because it's making money.
Right.
Because you and I are going out and buying stuff.
Right. Now,
and we have a job where our wages are growing. Not saying you and me, I mean we Americans.
No, we Americans.
So anyway, that's sort of the bull case for
that's the bull case
2026.
But there's always markets are two-sided, right? Yeah. There's a buy and a sell. For every person that's buying stock, somebody else is selling it to you.
Yeah.
So you intuitively, one of you doesn't agree with the other every single day. Well, what are some signs of that? Well, let's look at commodities, right? So we got the big one that affects all of us is oil.
Yeah.
When you go to the pump right now, it actually isn't too bad.
No.
I mean,
yeah.
I filled up the other day. I was like, wow, that's pretty awesome. So, again, those are political issues that are above my pay grade. I'm not here to, be pro Venezuela or negative Venezuela
or Iran
or Iran or any of those things.
Yeah.
I just know the price of oil is down dramatically
Yeah.
over the last 2 or 3 years. But the counter to that, the yin to that yang is gold. So gold is going through the freaking roof.
I mean,
It hit 43.68 by the end of the year. It's high. It's even higher now, early into 2026. You do need to pay attention to that. There are lots of reasons gold might be going up. We as we said earlier, the dollar's coming down. Well, there's a lot of countries out there that don't want to pay the tariffs. And they don't want to put their reserve currency in U.S. dollars.
Yeah.
So they just said, you know what? We'll just buy the oldest thing on the planet.
Yep.
We'll just buy gold.
And so, I mean, man, looking at this chart, it's kind of crazy. You see 2010, right around just under $2,000. A troy ounce is how it's valued. And it doesn't cross again until...
Not all 2020-ish?
Maybe. I mean, I think it hits it and then immediately goes back down, and we really don't have a breakout until this year, maybe 2024. But it's such a big breakout, like it's more than doubled. It's sitting at 4,368 as of the end of the quarter. So that's an amazing price appreciation in a short period of time, and that's not an endorsement of gold, but it is an endorsement of when you are investing, something might not happen for a long time.
Right. Oh, such a great point.
And then you get 10 years worth of gains in 2 years.
Yeah.
So, golly, it's fun to look at charts sometimes.
Yeah. For those of you that are interested in it, it is fun. All right, so let's switch, just looking at the sort of internals of the market, okay?
Yeah.
So the different sectors. I love this chart because I know it looks a little bit like a patchwork quilt, but it does show how big information technology is. And by the way, communication services, which is so infotech is 34%.
Yeah.
Communication services is another 10%. I mean, they've got Google.
I'm not saying they're the same thing, but they're not different.
They've got Google and communication services.
Netflix.
Meta is in communication services. Yeah, I guess you do. Gmail. I communicate with you through Gmail.
Yeah.
I might post something on Facebook or Instagram. I'm communicating with you. It kind of looks like technology to me. But
yeah, that's the smallest. Some of the smaller names in communication services are like, I don't know, like Verizon.
Right. They're tiny.
The communication services.
Yeah, they're a rounding error.
It's sort of funny, but just something to keep in mind when you're looking at those two sectors.
But it does give you an idea. These things do change, by the way.
Yeah.
I mean, this chart, this same patchwork quilt from 1980 looks totally different.
Yeah.
So maybe that's something we could do on another episode.
Well, go back and look at 2020. I mean, infotech and comm services are still big, but like healthcare, huge winner. And then it got absolutely crushed.
Yeah.
2022. So these are interesting to look at the end of every year, just because it does give a sort of quick and dirty of, man, what did well.
And then, all right, so then where are we? So we've got this breakout on corporate profitability thanks to productivity.
Yeah.
But look at the historic valuations. This is a fascinating chart to me because we look at it in 10-year increments.
Yeah.
And so on the S&P 500, the largest ones, our 10-year average price to earnings ratio is at 2022.
Or is that 22?
I'm sorry.
Yeah.
Is it 22?
Yeah, that's the 10-year average.
And the current PE on the S&P 500 is 27.
Yeah.
Now, for perspective, in 1999, that was at 40. So everybody's talking about a bubble. It's still different.
Yeah, we're halfway there.
Yeah. Yeah. There you go. But look at mid cap and small cap at, sort of 19 and 16. And small caps are right on their 10-year. So if you're looking out there and you're going, where's the value in this market? Like, what hasn't moved?
Yeah.
I mean, when I look at this chart, I go small cap.
Well, and the argument to be made for small cap is fascinating. So you look back 2022 and we start to raise rates. That is tough on small cap businesses. They just don't have big cash rich balance sheets that they can just, spend their own money.
Right. They got to borrow from
They
banks.
have to go borrow. And a lot of them,
from the market.
quite frankly, can't borrow from banks. They're too small. They're small caps.
So they go to private credit.
And so they go to, so they're paying, somewhere, at the time, probably 4 to 6, on its way to 6 to 8. And at the top, 10, 12, 15% on their debt.
Right.
So now you're seeing,
you better be growing at 30, 40% if you're going to borrow at 10 and 12.
And few are. And so you see rates start to come down and keep heading down. And you see AI boost productivity. Man, and you see valuations in line with, their 10-year average trying to break out with, if you look at the chart and you're into technicals at all, it looks like there's some resistance there, sort of at the 10-year average line, meaning as soon as it gets to that average, it should bounce back up. I mean, it is everything, and we have no idea, but it sure looks like pretty bullish for small caps. But again, people have been saying that for 10 years.
Well, speaking of borrowing rates, and let's just look at bonds real quick.
Yeah.
As we sort of get to the end of this, so to speak, but. This chart on the volatility of bonds, I wanted to just highlight it because we talk about it in stocks all the time, right? Yeah. We just talked about it with 3 up years, but in those 3 up years, there was a drawdown some point in that year. Well, guess what?
Yeah,
bonds do the same thing.
Yeah.
The difference is on a bond, it is paying you a set rate, and so you're getting some. Interest rate, kind of like a dividend on a stock stock that pays dividends. But I really just wanted to show this from the standpoint of, if you look, bonds do okay. Their goal is to keep you ahead of inflation and be a store of value so that there's something there. But don't forget these little red dots. Now, one thing to notice, these little red dots aren't that bad. They're down 2%, down 5%, down 4%. 2022, which we just experienced not long ago.
Historically bad.
And
not just bad. For this time period, like
for 100 years.
100 years. Yeah. It was so bad.
But even that, at the end of 3 years, we're back. Like, you were down 13%. Yep. Now you're working your way back up. So that was really more of a cautionary tale of, bonds can be great, but they do have volatility.
Well, they do draw down, and I think what's important is, if you own the individual bond and you see it,
hold it to maturity.
You see it on your statement, just because, you don't plan to sell it and it's paying you a coupon and you're going to hold it till maturity doesn't mean that can't go down.
Right.
There's still a value placed on that bond in the market. And a lot of people really kind of forget that because they just bought it for the income.
Right.
And all of a sudden they're like, how are my bonds down?
Yeah.
Because they have a price. And, if you sell them, you take a haircut.
Yeah. So, people buy and people sell.
It's a great reminder. Especially in 2022 where it's just so noticeable.
Yeah, very. So I wanted to point out with this, the corporate bond statistics, one of my favorite things, a lesson I learned super early in my career, if you look at this top right, it shows you the distribution of default rates.
Yeah.
AAA rated bonds, which are the highest and the best, all the way down to CCC. And what I hope you notice here is that, AAA bonds absolutely never default.
Yeah.
You know why? Because they always get downgraded.
Yeah. Straight A students never get Bs.
Right.
Because when they get a B, they're not straight A students anymore.
Right. It's exactly the same idea. So they always get downgraded first. It's my favorite thing is like, oh, that's a AAA bond. It won't default. No, it won't default as a AAA rated bond, but by the time they downgrade it to single B, probably going to default. So you've got to monitor your bonds.
And default is just a really nice term for saying they're not paying you your money anymore.
Right. They got to go through bankruptcy, and you might own equity in that company instead of a bond.
If you're lucky.
If you're lucky at the end. So I just wanted to throw that out as something that, people, you have to monitor your bonds like you monitor your stock portfolio. Yeah. You can't just buy them and forget about it.
Yeah.
So that was really sort of the point on that. So big picture, Lou, what are you seeing as we go into 2026? We covered a lot of it. What should we do?
Man, I mean, so I would tell you, watch the news only for entertainment. Don't watch it if that's where you're making your investment decisions. And I say that, with a smile on my face. But seriously, if you were watching in April of 2025 and you thought, holy cow, tariffs are going to screw everything up and I'm going to lose all my money, and you sell down 19%, and then you try and buy back, like, you can't. The market ripped up
10%,
10%
in one day.
In one day. So don't make rash decisions, because we are not even three weeks into 2026. And if you do watch the news, there's a lot going on in those three weeks. So I would tell you, watch it for entertainment. But man, don't make decisions on your portfolio. And then, as you're sitting here at the start of the year and, you're going through your New Year's resolutions and getting your financial house in order along with, everything else, go back to your plan. Talk to your advisor, hey, do we have a plan going into this year? Are we taking profits? What are we doing with our bonds? And just look at your portfolio, take your statement out, and evaluate what's your goal for 2026 and how, are you going to use your investments to get you there?
Well, I like what you've put down here, Louis. You said 2025 you got rewarded for staying invested, just like you just said. 2026, you probably need to be very selective and very thoughtful. And I think those are the right words to think about. Look at your plan, be selective, be thoughtful.
Yeah.
We're 3 years into a really good market. Earnings are good.
Yeah.
But be thoughtful.
Well, and not to end on doom and gloom, because I think
never end on doom and gloom.
We are overly positive people, and we just gave a bunch of positive reasons. But in terms of being thoughtful, looking at your plan, like, we're 3 years in, and at the end of every 10-year period, on average, there's 3 down years. Well, on the last rolling 10 years, we've had 2.
Right.
And it's a midterm election year. Again, that is not an endorsement to sell everything and go to cash. Stay invested. That's the whole point. That's where I started. So, hear me when I say that. But that's not to say that, like, man, there could be some pain, and it's been a while since we've had any.
Right.
So, anyway, we appreciate you listening. We hope you found it helpful, and we will see you next quarter.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell, or solicitation of an offer to buy or sell any security or investment, or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company Incorporated. Please note, past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.